Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, February 16th, and the vibe in markets is relaxed face, tense spreadsheet.
I love that vibe. It's like when your bank app says, "You're doing great," and your checking account says, "We need to talk." What are we hitting today?
4 stories, tight and useful. Stocks up on benign U.S. inflation and rate cut expectations, a Basel-linked push that could change mortgage capital rules, European coal futures jumping on supply risk, and Bitcoin hovering around that psychologically loaded $60,000 line.
So it's rate cuts maybe, mortgages may be harder, energy may be pricier, and crypto may be dramatic. That's basically my group chat.
A markets wrap. Stocks gained, bonds were steady after benign U.S. inflation data reinforced expectations the Fed cuts rates this year. Trading volume was thin because the U.S. and China were shut for public holidays, so the price action matters, but don't overread it.
Thin trading is when the market is basically running on vibes and leftover coffee. But explain benign inflation like I'm 5, and also like I'm trying to refinance.
It's basically like your grocery receipt stops getting worse. Prices might still be higher than last year, but the speed of the increases cools down. Markets translate that into the Fed doesn't need to keep rates high as long, so future borrowing could get cheaper.
So the Fed is like, okay, you stopped setting money on fire, we can turn down the heat. And stocks hear that and start doing jazz hands.
Exactly. For normal people, rate cut expectations can filter into mortgage rates, auto loans, and even what you earn on cash, like high-yield savings and CDs, though those often fall as cuts get closer. Actionable move? If you're shopping loans, watch the trend, not one day's headline.
Don't sprint to lock a rate because the market had a good hair day. But also don't assume lower rates automatically mean easy mortgages, because, segue, regulators love a plot twist.
Story 2. U.S. banks may see new mortgage capital requirements as the Fed gets closer to a long-awaited bank capital proposal tied to Basel III. In plain English, banks might have to hold more shock absorber capital against certain mortgage exposures.
So the bank has to wear a thicker helmet. Does that make mortgages safer or just more expensive? Or both, like buying the premium seatbelt package?
Both can be true. More capital generally means a sturdier banking system, less chance a downturn turns into a banking crisis. But if a mortgage requires more capital, the bank's return math changes, and they may respond by tightening underwriting, charging a bit more, or shifting what loans they prefer.
So even if the Fed cuts, the bank can still be like, congrats on the lower rate environment. Now show me your blood type and your third-grade report card.
Practical takeaway. If you're planning to buy in the next 6 to 12 months, focus on controllables, credit score, debt-to-income ratio, and cash reserves. And if you're an investor, watch banks with big mortgage books. Capital rules can affect profitability, dividends, and lending appetite.
Okay, mortgages are stressful. Let's talk about something relaxing, like coal futures spiking because of geopolitical chaos. What happened?
European coal futures climbed for a 4th day after a drone attack on a Russian Black Sea port that handles sizable coal exports, and as Indonesia tightened supply. It's a classic commodities move. Supply risk plus constrained shipments equals higher forward prices.
So coal is basically the backup generator of energy markets. When the delivery truck gets delayed, everybody panics and pays extra, like it's bottled water before a storm.
That analogy works. Why it matters, energy inputs bleed into electricity costs and industrial costs, which can show up in inflation, sometimes with a lag. If you're tracking the "will the Fed cut" question, energy shocks are one of the ways inflation can re-accelerate.
So we're back to the same plot. Inflation is that uninvited guest who keeps trying to re-enter the party. Actionable for regular people? Do we just stare at our utility bill harder?
2 practical moves. 1. If you're in a region with variable rate electricity plans, understand your exposure. Fixed versus variable matters. 2. For portfolios, don't treat energy as one thing. Supply shocks can lift certain commodity-linked assets even when growth is soft.
Now, let's go to the arena where emotions trade 24/7. Bitcoin. I saw the phrase $60,000 Tripwire. That sounds like a booby trap in a movie where the hero is my retirement account.
The idea, $60,000 is a key level traders are watching. If price breaks below and stays there, it can amplify volatility because of options positioning, dealer hedging flows, BTC-backed loan liquidations, and leveraged selling. Basically, mechanical selling layered on top of fear.
So it's like a crowded theater where one person yells fire, but also the doors are on a timer and the floor is greased. Even calm people get pushed out.
Exactly. And we also had another related item. ETF flows being down doesn't automatically mean panic, but it does mean marginal demand might be weaker. When demand softens near a key technical level, the market can become more fragile.
So the simple version is, when fewer new people are buying, the price needs existing holders to stay chill. And crypto holders are famous for being chill, like caffeinated squirrels.
Actionable risk management. If you hold crypto, size it like a high volatility asset, because it is. Avoid leverage you can't survive. Know where forced selling could happen. And if you're investing long-term, decide your plan in advance. Rebalance rules beat adrenaline.
Recap me, but make it usable. What should a normal, midlife, trying to grow human do after this episode besides stress-eat almonds?
3-step recap. 1. Rate cut expectations are supportive, but don't anchor on one quiet holiday session. Watch the trend in inflation and yields. 2. Mortgage availability depends on both rates and regulation. Improve your credit and keep documentation clean. 3. Energy supply shocks can reheat inflation, and crypto can cascade around key levels, so position sizes and liquidity matter.
And my step 4. Don't let a $60,000 number bully you into bad decisions. If you enjoyed this, subscribe and leave a comment with the one thing you're watching this week. Rates, mortgages, energy, or crypto.
That's it for today's Beyond Daily Finance Show edition of BD Daily Finance News Podcast. Share this with someone who thinks Basel III is a Swiss ski resort, and we'll be back with the next briefing.